steps to successful trading. So I'm starting a series here, and I'll talk about the first step, which is understanding. You probably have, if you have spent a little bit of time with trading, probably you have understood that trading is not just an activity, it's a journey, and trading is as much about what you know and what you can do and the mechanics of trading as about who you really are. And you need to follow a process that brings you to point A to point B, and in this process there are a number of milestones that you will need to reach. And in order to to complete this journey, you will need to change your beliefs about trading, about yourself, about what works in the market and what is appropriate in the market. And you will also need to change some of your behaviors, what you do or must do, or what you don't do, and you have to start doing. So what you really have to stop doing and stop believing in, and what you have to start doing. And you need to establish a routine. This might change or might need to be established, and follow it with discipline. Now, trading is not a job, it's a business. Don't treat trading as a job, because it is not. It is a business, and at all the ups and downs of a business. A business can generate great returns, but does not flow easily as a job does, and it does not guarantee always a salary, or it does not guarantee that you make 10 wins in a row, or you don't make 3 or 4 losses in a row. Don't expect an income from trading. The returns are variable. It's the nature of every business. The returns may be very, very high, but they're variable based on the kind of business that is offered to you. And the market does not always offer steady flowing of opportunities, or maybe the trades do not flow easily and regularly, and they always have positive results as you could have in a job. In a job, you always get a salary at the end of the month, but that's not the case of trading. So for this reason, do not force returns which aren't matched by some kind of work. Sometimes, either it can happen that you don't trade for a long time, you come back to trading, you go on holidays, you come back, and you kind of want to make up for the time you have lost. That's not possible in trading. And also, although sometimes gains comes without effort, typically it's never possible to force returns without some kind of work, analysis work, obviously matches those returns. Yes, we can be lucky at times, but in order to get the best opportunities, we have to match those with some kind of work, and not always the market actually honors those setups which have been very, very well researched. In fact, the market can do anything, as we'll see later on. So trading is a business, and as you can see in this model, this is the 7 pillars of trading in modern markets. I presented this on FX Street, and if you are interested, you can actually review. You can actually review the this presentation on FX Street. Look for it. The first presentation, it's open presentation. There are a number of 3 or 4 presentations I made on the 7 pillars, and some of them are premium presentations, but I suggest you watch the 7 pillars of trading in modern markets, the first part, which is free and open. And when you watch that, you learn that there are portions of the model that are related to mechanics of trading, particularly this area here, the upper left area, and they relate to the method, the timing, money management, risk management, all techniques and skills that actually can be learned. So you don't have to, if you spend enough time on that, you don't have to really change yourself a lot in order to learn that. In order to follow them, maybe you have to change yourself a bit. and make sure that you consistently follow the same method and use the same type of analysis process to identify opportunities. Okay, so the remaining part, 75% of it, is probably the psychology of the market. The psychology of the trader. The psychology of the market is still something that I incorporate into the mechanics of trading, and we have some methods that we use to basically map the psychology of the market. And particularly in my case is really how dump money, smart money is positioned in the market, which gives us as price structure and a map of the psychology of the market, in a way how smart money responds to the way group of average traders are placed in the market. So that's the response of smart money, and the response of dump money is how the group of traders and followers of traditional technical analysis actually position themselves in the market. So that gives us a lot of information, actually. Okay, so what I'm going to do now, just want to activate here the charting here, so we can actually, because I'll need to use this later on, so let me open a meeting here, and I'll use this to annotate the charts as well. So the point that I want to make here is that at the very center of all, there is the trading as a business element, which is one of the pillars. And I believe that probably be successful if you really consider trading as a business. Anything different will generally not work. If you try to force a salary, or you actually, I'm going to share the screen here so we can actually annotate this. That's the way I do it, and so so as I mentioned, this is the mechanic of trading. The most important part is not this one, but it's the remaining 75% here, which is the psychology of the trader. But around this, and centrally, there is an important area which actually brings everything together, and that's considering trading as a business. That's very, very important. Now, when you start and you are interested, you develop an interest in trading, don't just try to make some money, but rather learn skills that will serve you for life. A lot of people, the majority actually, might actually be interested in trading and trading for years, but they never learn skills. If you want just to make a few quick bucks, maybe use something different. Don't use trading. And the reason is either you will always be depending on someone else, or you will not learn any skills. Okay. When that someone else is gone, if you follow someone else's signals or indications, you will need to keep looking for someone else and find others, and it's very difficult to find people who can guarantee your quality and consistency. And also, you have to remember that markets are changing all the times, and so the point I want to make here is that don't consider trading just a way to make some money. Just get involved in it only if you want to learn new skills and you want to improve your skills as you go ahead. And if not, and you have dreams about trading, you will eventually need to renounce your dreams, because if you don't commit on learning skills, the magic is not going to happen. So the good point is that obtaining consistent results is possible in trading, and you can really dream big. But if you don't commit on learning skills, what happens is that you'll end up like 95% of traders that lose money because they never learn effective skills. So measure yourself and make sure that if you're spending time on trading, you're also learning something. And something that can serve you for a life. So what are the 10 steps of successful trading? Well, the first one, and we're going to focus on this today, is understanding. The second one is risk and reality of trading. Third one, the mechanics of value trading edge. You have to have that. You have to know the mechanics of price, and particularly when applying a method that has an edge. The execution of simple trading plans. You may be surprised that most of people are not able to execute simple trading plans. When I mean execute, I mean to stick to the execution, to stick to the plan, and to be able to input trading plans correctly and execute them correctly. A lot of people enter on trades when it's too late, and despite you specify them that they should not be involved at that time, the time they should be involved is only when the price is at the entry level or around the entry level. Some people, they just they're not able to execute a simple trade plan, and it's not about doing the activity, it's about the emotional participation, of course, and the fear of losing the trade. Step 5 is money management and how we use it to reach objectives, and that's something I'm going to talk about tomorrow as well. And I want to actually look at when you look at FX Street in the next 3 days, I'll have different webinar, and the first one is the one of today, and you can actually watch this webinar as well. Tomorrow I'll have a premium webinar at 8 a.m. EST, Trading Success with Money Management. So I will touch on some of the concepts that I'll explain in step 2 are also touched in this Trading Success with Money Management, and that's something that if you're interested, tomorrow 8 a.m. You can join me. This is a premium webinar, so you will need to have subscription. And then on December the 16th, there'll be also the event related to the forecast. There's going to be the one day, one topic, and I'm going to talk again at 8 a.m. on Friday, and particularly I will analyze how smart money and dumb money are positioned for 2016. So if you're interested, definitely don't miss the one day, one topic. Now, step 6 is related to, it's actually changing gear here, and I will talk more about the distinction between being able to perform step 1 to 5 to the abilities that you need to perform step 6 to 10. But step 6 is about increasing return with price, structural analysis, and timing of opportunity on smaller time frame, like 15 minutes or 1 hour. And that allows you to increase the reward to risk way above what you can do if you only know how to execute and use money management to actually reach your objectives. Step 7 is about identifying trading system or picking trading system that work for you, very, very important. And step 8, 9, and 10 are all part of reaching mastery. Step 8 is about your discipline and psychology, so improving, and there are objective and structured way of doing that. Step 9 is measuring and improving. In fact, measuring is the only way to improve something, in this case to improve your ability to take low risk trades and manage risk properly. And finally, step 10 is mastering reality. Step 10, it's a process, not a point in time. So it's really a cycle between 8, 9, and 10 and that allows you to improve your skills. Okay, so that's basically the way all this basically works here. Now, the okay, so today I'm going to briefly talk about step one, which is understanding and understand. You have to understand what you got yourself into, okay? And this is a business with so few constraints that you can ruin yourself very quickly. And in fact, that's exactly what happens to 92 to 95% of starting traders who lose between $2,000 to $6,000 in 3 to 6 months. You hear, that's an average. So you hear people who last a little bit longer, but you also hear people who lose that money in 3 days or in 5 days or in 1 week. In the Eastern countries, it's slightly lower, 1,500 to 4,000, but the story is exactly the same. So it's something that it's kind of grounded in the nature, in our psychology and nature. Cynics believe access to markets is being granted to the masses to separate them from their money. So that seems to be in line with this number here. And as rules are now given in this in the way we trade, and asymmetry of information is the only rule. In fact, there is a huge conflict of interest. You need to adopt ways to protect yourself. So how do you protect yourself? Luckily, people with a profound understanding of trading, the markets, and psychology came to help. I had the privilege to work personally with some of them, Van Tarp and David Asley, but there are other people who came to help, Mark Douglas, Alexander Elder, Jody Napoli, and others as well. So you need to understand that you're likely not to make it alone. That's for sure what happened to me. When I started for almost 6 years, I wanted to solve the market myself. I wanted to solve the problem myself. I wanted to. I was very ego-driven, and I thought I could apply my software engineering skills to solve the markets, but I was not able to do that. And only when I realized in 2006 that I needed mentors, I started research mentors, and it's very, very difficult to find people who are willing to help in the markets, and they stay long enough and are willing to help long enough for you to make the transition. And it's very, very difficult. So if you get a hold on a good mentor, keep the mentor. So step one is about understanding. So it's about pondering what you have to ponder. You have to ponder the truths and principles. Particularly, I make always reference to those specified in Trading in the Zone, which is the book for Mark Douglas. Probably, if there is one book to read in trading, that's the one that you have to read. I've read almost 300 books on trading, and the point is, most of those books in a way didn't help me, meaning that they created beliefs about trading that was very, very difficult to kill, to eliminate. So in reality, the less you know about trading, if you're starting, the better it is for you. And the best book of all, it's not about the mechanics. The best books are not about the mechanics of trading. The best books are about the psychology of the trader, and Trading in the Zone beats them all, in my humble view. So it took to me several years to incorporate these thoughts and principles in my trading, and I had to tweak until everything I do now incorporates all this. And again, it doesn't mean that by incorporating this you will not have losses. Losses are not cannot be avoided or eliminated, but I know that I'm compliant with them. So there are 5 fundamental truths that you have to learn, and you have to make sure that you incorporate in your trading. The very first one, the most important one, is anything can happen. The market can do anything, right? So if you risk a lot, 10%, 20%, it means that really you are not considering this, or you're not considering this in a consistent way. If anything can happen, and an event like like the Swiss franc that opened lower over the weekend, with this kind of risk will wipe you out. So, high risk is not compatible with this fundamental truth. You need to know that you don't need to know what is going to happen next to make money. In fact, you have to take position, trusting your edge without knowing whether that is going to be successful or not, and without trying to get information about how to explain the next move in price. That's something that in 2005, 2006, I did a lot. I put up a trade, and then I started rationalizing why that trade should work. In reality, that is not good, because it actually distracts us from a simple thing, which is observation of price. There's a random distribution between wins and losses for any given set of variables that define an edge. So whatever edge you have, that is the outcome of your trading can only be described by a distribution. And when you extract a population from the distribution, there can be a sequence of winners or losses. It can be a streak of winners or losses that still are possible and are an outcome of that random distribution, and you have to accept them. So that's the only thing that we know about our trading edge, and our trading edge can also be defined by the outcomes, which is particular population of our trading, our trades, the sequence of our trades. The point is that it's a random distribution, and if it's possible for that random distribution to generate 7 losses in a row, or 5 or 3 or 4 losses in a row, that's something that you have to get to accept. Of course, you have to have proven yourself before that you are indeed trading an edge. Okay, trading a method that has an edge in the market. An edge is nothing more than an indication of high probability of one thing happening over another. And this is a slightly different way of looking at it. We'll never know the outcome of one trade, and we only can accept the fact that that trade was identified using rules that actually normally express a high probability of one thing going in your direction over another thing happening. And that's the only thing that we can say about trading, which means that we will never know the outcome of one specific trade. And in fact, we have to learn to accept the fact that the next trade is going to be a loser. And so you have to accept your 1 unit of risk and hoping that that 1 unit of risk is small enough to not create any damage. And we'll see that in step 5, we'll see that we don't need to risk a lot. We need consistent results, because then money manager can help us reaching objectives. And that's also exactly what I'm going to talk about tomorrow in the premium webinar, Trading Success with Money Management. Okay, so if you're interested in ways to increase your returns by using money management, then in a creative way, which of course looks at risks on. We're not talking about optimal F or Kelly criterion and these very risky money management schemes, but we're talking of other methods that can help you, if you have consistent results, to increase your objectives or increase your overall gains. So if you're interested, don't miss that. And number 5, every moment in the market is unique, and there can be something, there can be just one event, like a large trader coming in that pushes price below stops level, that can change completely the outlook of that market. So in reality, even exactly the same pattern, exactly the same situation in the market can lead to completely different results. And that's the reason why the probability of patterns, the typical patterns of technical analysis, it's very, very low. And you cannot just trust that. Okay, so every moment in the market is unique. That basically outlaws all the patterns that you know about price. because even if that pattern is perfect, the underlying market conditions of the price action will be completely different, and maybe just one small change that actually changed completely the balance between buyers and sellers, demand and supply. So the other information that you really have to accept, know, and understand, ponder profoundly is the 7 principles of consistency from the same book, Trading in the Zone. And I'll go very quickly through them. I objectively identify my edges, so you have to write down and consistently repeat what you identify as your edge. And the only way to identify objectively something is to write it down. In fact, for example, I have trading systems written down so that we know what is the edge that we are following. We can measure what we are doing against what we should be doing. Number 2 is I predefine the risk of every trade, and my risk is 1%, and people laugh at me, but I will talk more about that. The reality is that if you can be successful with 1% consistent, then with money management you can actually increment your risk in ways that do not damage your portfolio if an adverse event happens. And I do not change risk based on how good I feel about a trade. Okay, I might take the trade in slightly different ways, doing slightly different assumptions of where the stop could be, using always a small risk. But I predefine that risk for every trade. I completely also accept the risk, or I'm willing not to let go of the trade. There are some people who put up a trade with a very, very large risk. They don't even know what the risk is. In fact, I have statistics from Oanda here. 22% of people don't even use risk management. So, and they get stopped out due to margin calls. So here there are a lot of people, and these are only the people who get the margin calls. Okay, so clearly there is a much higher number of people who don't have no respect the concept of risk. They don't even know sometimes how much they're risking. So they cannot complete accept something they don't know. Okay, so that's one of the reasons that a lot of people do not accept their risk, because they don't know it. But then when the trade goes against them, they are in panic, and either they stay and they accumulate losses, or they exit at the very wrong moment. If you're late a trade, you should be letting go the trade, because the risk at that point, even it's too high, or the reward is not significant when it's compared to the risk. So sometimes you should just let go your trades. And number 4 is I act on measures without reservation and hesitation. And you have to take the trades when you have the signals. Case closed. And there might be signals sometimes that they basically represent the same trade, and there you can actually make a choice and say, I'm going to take only one, because that would be like risking 2% of the same trade, and that makes sense. Okay, but generally, if you're following a method and it gives you a signal, you have to follow it. You'll never know which signals or which trades will actually succeed. Okay, so you have to act on your edge without a reservation or hesitation. I pay myself as the market makes money available to me. That's kind of extracting always something from your account. And it's a way to patch your back, and also it's a way to build a reserve. I continually monitor my susceptibility for making errors, and that's something that I do by reviewing my trades monthly and understanding what I have to change, if I have to change something, what I would have done differently. And I take notes. I keep taking notes, and I keep improving. Number 7 is a kind of a clause that guarantees us that we will follow all the first 6 principles. And it says, I understand that the absolute necessity of the principles of consistency of sex, and therefore I never violate them. And basically that's a guarantee clause that should make sure you follow all of them. So ask yourself today, do you believe the fundamental truth of trading, and are they including your trading, a trading system, trading method? And also, are you following the 7 principles of consistency?